Now more than ever, innovative technologies are fueling change and sparking new ways of thinking. Collaboration between corporations and startups is key to staying at the forefront of these trends. However, finding the right startups can be expensive, time-consuming, and ineffective. But Plug and Play is here to help. As a corporate partner, you will gain access to a whole ecosystem of innovation. Discover startups that meet your tech interests. Stay updated on the latest trends and network with industry peers. We will help you during every stage of your innovation journey, no matter where you are and where you want to go. Get in touch today.
Hello, everyone. Thank you so much for taking time out of your busy days to join us for this month's edition of Plug and Play's monthly crypto talks. I'm joined by my co-host Kavi Dewan, and today we're going to be talking about one of the most hot topics in crypto, which is tokenized securities. BCG is predicting that this market's going to hit 16 trillion by the end of the decade, and with so many different applications and making more cost-effective and efficient capital markets, it's one that we are going to be very excited to discuss today. So Kavi, I'll let you go ahead and turn it over to you to introduce today's speakers.
Thank you, Patrick. And hey, everyone, welcome. It's great to be back. This month, as Patrick mentioned, we're going to be discussing asset tokenization broadly, and then more specifically, the role of security tokens, the tokenization process itself, etc. We think that asset tokenization, it gets talked about a lot. It's clearly a key enabler of open finance and a lot of the other important areas within crypto. So I wanted to, before introducing our great speakers, give a bit of a primer on some of the things we're going to discuss today, starting with an explainer on tokenization. A tokenized asset is simply a piece of data on a blockchain that says someone owns something. And token standards, I'm sure you folks have heard of ERC20 and ERC721, two of the most common ones. These are just the way the data is formatted. We like to think of them like JPEGs or PNGs. When data, it needs to be tokenized and standardized to enable sort of all these downstream benefits of interoperability, of composability. And because of these token standards, lots of different types of things can be represented on chain. So fungible assets, things like stocks and currencies, as well as non-fungible assets, things like paintings and tickets. And so that was the high level, but it begs the question, after you've represented some asset on the blockchain, what now? What is the purpose of tokenization? What are the use cases? These are some of the things that we want to dive into today. And with that, I'd like to bring on our two amazing speakers today, Jeannette Spaulding, co-founder and CEO at Tokenwise, and Bob Ejodame, the VP of Capital Markets at INX. Bob, Jeannette, thank you for joining us. Why don't we dive in by starting with your backgrounds and sort of your journeys into the crypto space, as well as sort of a brief explainer of what your companies do. Bob, perhaps we can start with you.
My background spans about 20 years in financial markets, traditional financial markets, and I've had varied roles from global operational roles to being a product owner on middle and back office systems, market surveillance. I've mostly kind of straddled the space between the business and technology and kind of like translated for both, both ways. So I'm particularly well suited, I suppose, to kind of growing a business or a space that has a strong technology element to it. I got into crypto and digital assets in around 2017, mostly to dabble and just kind of see what it was about. And then in 2020, I joined INX. At the time, I had been looking for, I literally was saying, I want to get into digital assets. I want to get into crypto, but I'd like that to be a regulated play, some kind of firm with, rules and adherence to regulations, because I came from that world. So it was really, I want to say, a stroke of luck that I came across an ex-colleague of mine posting about the INX IPO. And I said, this is great, well done. And he goes, are you looking to, we're hiring, we're bringing people on board. And that was kind of how my story at INX began. So that's me.
And I'll hop in with my intro. So my name is Jeannette Spaulding. I also started out in the traditional finance world. Started my career in Paris working at BNP Paribas with institutional investors to develop investment strategies across multi-asset portfolios. Worked a bit also in private equity in Paris at a French investment bank called Natixis. And then moved to London and worked at BlackRock for a few years on a multi-asset investment strategy team that was managing portfolios for some of BlackRock's largest clients. So central banks, sovereign wealth funds, and corporate pension funds, and also public pension funds were our clients. And we basically crafted holistic, not only the investment strategies, but also risk management and the tech side of things as well. And that was really when the tech bug bit me. I ended up teaching myself how to code in the evenings and on weekends. And before I knew it, I was a fully fledged fintech enthusiast. So then I left to start my own fintech consultancy where I was helping blockchain startups with their strategy and operations. And that landed me back in New York in 2017, which for those who were in the industry back then was the height of the ICO boom. So initial coin offerings, which are different from STOs, security tokens offerings, which we're going to get into. But back then, it was a bit more of the Wild West. And with me, with my institutional background, I was really helping a lot of these startups to build the right way, build in compliance with regulations. I very much agree with Bob in the sense that anything that you do in this space should be, in full compliance with the rules of the jurisdiction you're in. And so I've always had that perspective to bring to startups and now more mature organizations and enterprises and institutions that I work with today. So I've been in the blockchain space since 2017, but I've also helped the traditional finance side of things with digital transformation initiatives. So I also worked at the VP level at institutions like Bank of America and BNY Mellon, helping them to modernize their tech stacks and also launch tech products that would enable them to kind of take transfer pieces of the way that they did business into newer tech stacks and more modern ways of approaching technology. And then most recently, I was at Invenium, where I was leading a few different initiatives regarding blockchain services for data. So for example, blockchain oracles for data that comes from physical buildings, for example. And now I have co-founded Tokenwise, which is accompanying organizations, businesses, as well as institutions that are approaching tokenization, either from the perspective of they'd like to tokenize a security or an asset, both in this case, or they are just exploring this landscape and trying to see, really what is there that can be done with blockchain technology to make businesses more successful, more efficient, have an easier time raising capital. So we really build a strategy around those pillars and then accompany organizations as they deploy these strategies.
Very, very exciting. And thank you, Jeannette. Thank you, Bob, for your backgrounds. I think it's incredible. The enterprise focus, the traditional finance focus, it's going to be very helpful for the folks in the audience and relevant. And Jeannette, thank you for sort of giving the overview of Tokenwise. Bob, perhaps you could do the same for INX. I want to start on level playing field so the audience knows what both of the companies do.
Yes, thanks. So Jeannette, you said, 2017 was kind of like the Wild West. It was the Wild West. At the time, the founder of INX, Shai Datika, he's the entire INX team is from traditional finance backgrounds, and we were basically looking at what was happening in this ICO space where companies were just raising millions of dollars on the back of a white paper. And the thinking at the time was there should be a way for companies to raise money from retail, but it should be done in a regulated manner. And those retail investors should be afforded the same protections as the Securities Act of 1933 stipulates, right? That there should be full disclosure of risks. Basically, investors should be fully aware of what they're getting into. So, so Shai, our founder, approached the SEC and said, I want to do a blockchain-based IPO. and obviously not calling it an ICO because that was becoming a bad term at the time. Let's call it a security token offering, an STO. And that took 3 years, over $1 million, Ernst & Young, multiple law firms going back and forth with the SEC, effectively co-paving this way, with, hand in hand with the SEC for INX to be permitted to raise money in a full F1 prospectus IPO. Just under 3 years later, the approval came. This was in 2020, around July or so, and INX started its IPO, or STO. And 9 months later, we had raised $85 million from 7,200 retail investors from 64 countries around the world. And a lot of that $85 million actually came in through like stable coins or crypto. So we had basically proven the model, and INX then took the funds that were raised and acquired licenses. We basically went on a license acquisition spree to build this arsenal of licenses to the point where we'd have a broker-dealer license. We're a registered transfer agent. We have a licensed ATS, which is a platform where you can list and trade security tokens. And we also have so far acquired 45 money transmitter licenses from 45 states that allow us to offer crypto services on our crypto exchange. We then took, what we're able to provide through those licenses and merged all of those solutions in our flagship platform called INX One, where investors or traders can basically access a capital raise marketplace where other companies are now raising capital the way we did through the regulations and the auspices of the US SEC. Investors can access the secondary ATS, the secondary marketplace, where they can trade tokens. And they can also access the crypto platform and easily kind of move their funds back and forth, between both platforms, even though behind the scenes there are different regulations and so on. But what we've done is cleverly kind of merge the solutions while still abiding by the rules. So we've basically gone through, those early days to the last. Okay, we've basically gone through the last 6 years now of, bull cycle, bear market. And I think someone's someone
Apologies. I need to mute my mic. There's some background noise.
That's okay. That's okay. So look, 6 years in from that, beginning that journey, when we look at the way the market has evolved, over these years, there have been various trends and various kind of hot topics or verticals within the crypto space. I mean, back then people talked about privacy coins, and then there was talk about, there was the DeFi summer, which was in 2020. That was really exciting. And then you suddenly had the NFT explosion, where suddenly OpenSea, the primary marketplace for NFTs, was doing more volume than Uniswap. And so the question, I suppose, on many people's minds should easily be, so what's the next big thing? And we're pretty confident, and we're very much encouraged by what we're seeing out there, that is going to be security tokens. And don't take it from me, take it from Citigroup, from BlackRock, from Bank of America, and so on. So anyway, that's the story of INX. We've basically built our entire regulatory umbrella to where we can now handhold customers through the same process that we went through and enable them, raise capital from retail.
Got it. And thank you for that context and the story of how INX was founded. I remember when Constitution DAO was happening, and 2,000 people, they raised 40 million, and they had this failed attempt to buy the Constitution, and it was silly, and everyone laughed. But the underlying mechanism is sometimes what gets overlooked. And when you talk about INX raising 85 million from 7,500 retail investors, regulated fashion for real business, that's when things get really exciting. And, you know, both you and Jeanette, you sort of alluded to it, but I want to ask and sort of kick things off with sort of a question that'll lay the foundation for our discussion today, which is, you know, what is the core purpose of sort of bringing assets to the blockchain? Is it solving a real problem for traditional finance? What are your perspectives? Jeanette, maybe we could start with you.
Absolutely. So there are a few things that I think represent major benefits of tokenizing an asset specifically, to say, you know, when we're talking about real world assets, that could be something like real estate, it can be a stock or a bond, it can just be something that has a life in the real world. And then you put that on chain in order to basically get the benefits of, in terms of operational efficiency from things being on chain. That's what we see a lot in the institutional space, where you have fund managers, like large real estate developers, financial institutions that are looking at this from the perspective of managing millions, even billions in assets. And when they're able to effectuate cost-cutting measures using innovative technologies, that's what they're looking at right now in terms of how they're using blockchain and how they're viewing tokenization. It's as a means of being able to organize data around their assets in a more efficient way, in a more auditable way, in a way that allows them to program compliance into these assets, and in a way where they can have potentially instant settlement instead of, you know, what the process looks like now. And so from the institutional perspective, it's really about building better business performance from an operations perspective. But then you do also have the capital raising side of things, which maybe I'll let Bob, turn it over to Bob to kind of dig into some of that, because his perspective I find is very interesting on that piece.
Yeah, absolutely. I mean, the first, you know, obvious benefit is a fully transparent cap table that updates in real time. Right. So, you know, going on Etherscan on the public ledger of the blockchain, investors, third parties, auditors can literally go and look at the smart contract, and they can see where all of those tokens sit. And on the INX side, as a licensed transfer agent, you know, we are obliged to maintain that cap table on behalf of our clients who are raising capital on INX. So you've got the auditability, the immutability of those records, but there are also, you know, from a capital raising and from the perspective of INX's business, there are some very easily understood benefits. So, for example, just yesterday, I want to say, the day before, we distributed a dividend in the form of USDC stablecoins to a couple of hundred wallets. And it literally took, you know, the actual action of pushing the button and pushing the funds out. You know, you're looking at a couple of hours of just kind of like cross-checking stuff and making sure everything was ready. And the issuer of the security token, all they had to do was just instruct INX to distribute the dividend. And we did that, and then, you know, people start receiving, you know, alerts from their wallet systems saying you've received USDC, and you know, so this is a very clear-cut example of the efficiencies afforded by the blockchain in, you know, managing the security token space.
And you know, I agree. I think that it's incredibly fascinating, and that's phenomenal that you guys were able to do that. One of the things that's on everybody's mind right now, especially with certain hearings that were held in Congress, is what exactly is separating these securities from the currencies themselves. That seems to be a very big question that's being asked. And so we'd love to hear both of your perspectives on that particular issue of how this tokenized security is different from the currencies and from cryptocurrencies generally speaking. And then what is the process of representing these assets as tokens?
Yeah, so I think one of the main differences is with the cryptocurrency. First of all, why do you use a cryptocurrency? If you're using it in its purest form, it's a medium of exchange. So basically, you are not holding that in order to turn a profit or reap the benefits of any underlying protocol. If we're talking about a cryptocurrency, so you know, the currency is the use case for what you're using that for. And with cryptocurrencies, they are bearer instruments, they're bearer assets, which means that they're in your wallet. And as long as they're in your wallet, you are the owner. But if you transfer that to a different wallet that's not under your ownership, you're no longer the owner. Or if you lose that wallet, you may no longer be the owner because you've lost your ownership of the actual coin, of the cryptocurrency. Whereas with security tokens, these are registered securities. And if we talk about what is required in the US, you're going to have a whole framework regarding how the record of ownership is registered, and your name will be attached to the ownership record for that token. So therefore, if somehow it does get lost or stolen, etc., you're going to have a digital transfer agent that can restore your ownership by either issuing a new token or by taking back the token, because a lot of token standards, the smart contracts have capabilities where you can force a transfer. So if someone somehow steals your security token, and if it has the right kind of smart contract attached to it, you can actually repossess the security token from the thief's wallet, right? So you have with security tokens this idea of ownership, which is protected by securities law, and that I think is one of the major differences that in people's minds they're like, oh, I get it now. This isn't the Wild West. This isn't, if I lose my wallet, I've lost my entire investment. This is basically a way to give access to a broader set of investors these securities and these mechanisms that have been usually reserved to a different level of investor previously. But in terms of the rules that you have to apply to these tokens, they're the exact same rules that apply to securities.
I would also add to that the most of what people kind of think are cryptocurrencies are mostly some form of utility token or the other, right? The true definition of the currency, one of which Jeannette alluded to, is being a medium of exchange, or it's a store of value. When you look at the security token, it does embody a different type of value. It carries a whole different type of financial rights that is very, very tangible. And whether it's tangible as in the sense of being a physical asset, like classic car collections or wine or real estate, it could also be a less physically tangible value representation, like a debt equity, like fixed income. And so it's a lot easier to look at a security token and understand the value that it represents than 99% of what people think are cryptocurrencies that are trading on a vast majority of exchanges out there. As far as utility tokens are concerned, one more exciting thing about security tokens is the fact that they also can convey utility benefits very easily. And so just imagine being an investor and holding tokens in your wallet, being able to show those tokens to a third party, a different application or ecosystem or vendor, and being entitled to some kind of loyalty or VIP kind of discount or service. So they're really multifaceted in the way they work. Whereas when you start to dive into the classic sort of crypto, what people would call a cryptocurrency, you'll find it has a very limited, benefit, utility benefit to its own very ecosystem, where, it's all about basically, who stands to gain from the activities, of everybody else in these ecosystems. So they're distinctly different.
That's a great point. And I also add to that, the distinction between a utility token and a security token is probably even more sort of something to highlight, and what people expect when they have one of those tokens. So with the utility token, in general, a lot of people are using them for speculative purposes, whether they're meant to be used for that or not. A lot of people, instead of holding a utility token because they're planning on using that on the platform, they are actually planning on, they're hoping that it will appreciate, which then makes that asset, that kind of asset, very speculative and very risky. Whereas with the security token, it's as much about the legal structure that has gone into forming that security token as it is about the technology itself, because the token itself is really just an encapsulation of that legal structure. So like Bob was saying, if it's, debt ownership, equity and equity interest, et cetera, that's what you have with the technology is really just proof on the blockchain that you have legal rights to an economic interest, profit sharing, that you are going to be getting some sort of like interest payment, et cetera, and it's up to the issuer to decide whether this is going to be a debt instrument or an equity instrument or profit sharing or what have you. But it's really about that first step of just defining the legal structure and the economic terms, and then you encapsulate that into a token. And so then when you have investors that invest in a security token, it's still speculative, but they know what they're in for. They know if it's debt that they can expect to receive interest. They know if it's equity that they're going to actually have ownership interest in that entity. So there is there's actual value, intrinsic value that's backing that security token.
Definitely. And I think that it's incredibly important to get these definitions correct and everybody on the same page, especially when it comes to sort of like what everything means. And a lot of times lines get blurred. Like, as you mentioned, people are buying tokens that are meant to be used for sort of on-app purchases or in ecosystem purchases and are using it speculatively. So figuring out exactly what that means in legal terms is going to be critical for adoption and for regulation. And speaking of that, we would love to sort of transition from tokenization broadly to security tokens specifically. And would love to start off with hearing like what regulatory, technical, and operational perspectives are businesses considering now, and what do they need to be considering as they sort of adopt and want to use these kinds of vehicles for fundraising?
The beautiful part about the regulatory angle is that the regulations around securities have existed for, since 1933.
Yeah.
The Securities Act has worked for the space. There have been various other regulatory initiatives or things that have been rolled out over the years that have made this entire space a lot more mature, where investors are a lot more protected. So specifically, when issuing a security token, there has to be some kind of filing, some kind of prospectus, a memorandum that gets created by a lawyer, so a company looking to raise money would basically engage counsel and prepare this prospectus, which basically details what the investor is getting into. And not just the upside, but also potential downside. Like, it should be very clear that risks come with every type of investment, and they should be spelled out. That's the level of regulatory clarity that the regulation should ensure gets provided to the investors. There are licensed firms that are allowed or permitted to handhold, clients through these processes, like a broker-dealer, which INX is. And so when I, basically bring clients into our pipeline who are looking to raise capital, while they would engage the lawyer on their side, we're always kind of handholding them and making sure we kind of go through the prospectus as well, and that it matches up with what, their expectation is. So it isn't really that complex, because it isn't some kind of new regulatory space that has come about through digital assets. It's the same rules and regulations that have existed for a long time.
Yeah, I would agree with that. And I would also say it will depend on what you are tokenizing. So for example, we see a lot of activity with funds that are tokenizing. So you have when you tokenize a fund, that's going to represent an interest in that fund. And usually funds like that are managed by fund administrators. And so from an operational perspective, that's going to look quite different than what it would look like for a startup to tokenize its equity. And so really, as we are seeing the industry evolve, we are seeing a lot more actors from traditional finance. So, Bob mentioned broker dealers, and they have been involved in this ecosystem for quite some time, but we're also starting to now see, entities like fund administrators that are modernizing by working with different platforms to get integrated into their process, because a lot of their fund manager clients are coming to them very interested in tokenizing funds, but you have to integrate, with a fund, when you have a fund and it's a registered fund, you need to have net asset value that's calculated. And how do you create operational processes that allow you to have a valuation on a tokenized fund, and how do you integrate all of the data in that way? So that's going to be a little bit more complex than a company that maybe doesn't need to do that on a regular basis. They don't need to be doing potentially as much reporting, and it does depend on the legal structure as well. So there are, there's Reg A, Reg D, Reg CF, all of which are these legal structures that are exempt from registration, but do have certain reporting requirements. And those legal structures, depending on what kind of asset you're tokenizing and what your business goals are, and what your pool of investors looks like, you're going to go to one of those structures if you're in the US. And then all of those will have different requirements in terms of your reporting requirements. Like the Reg A reporting requirements are going to be a little bit more in-depth than a Reg D, for example. And that all goes into the process as well. And the wonderful thing about tokenization platforms is that that can all be automated, and it just makes that process so much more streamlined and compliant. And we're just talking about the US. If you're looking to go into other jurisdictions as well, it can be a bit much to navigate. So when you can have a technology partner that's able to help you navigate globally, that is just something that in this world of global trade, it's a benefit of tokenization, but you also need like the right tech and the right operational stack in order to do that.
And just to add real quick to that, to the example of the fund being slightly different from, say, the company or the SPV looking to raise capital, again, the Investment Act of 1940, it exists. The framework is there. So again, from a regulatory point of view, there aren't any new fancy, complex, regulations that are in place that have to be understood. It's the same as it has been for decades.
Yeah, wow. And as you both are speaking, I'm realizing that a lot of the things that people think are going to be complexities and obstacles to asset tokenization, to security tokenization specifically, have been thought out. And I sort of want to double click and unpack some of these things for the audience. We gave the fund example, and Bob, you gave a couple more examples. But I just sort of want to ask at a high level, what are the types of companies, what are the types of businesses that are ideally suited for raising through security tokens? And that's part A. And then part B is, what does that process actually look like? So how do they start once they've decided this is the route for them? And in the case that they're working with INX or Tokenwise, what are the steps?
Jeannette, you want to go first?
Okay.
Sure. Yeah, sure. So I would say a lot of the assets that we see where it makes a lot of sense to consider tokenization is commercial real estate is a huge area, particularly real estate that has already been constructed, is already generating some form of income, because then it's more streamlined to establish a token that is a profit sharing mechanism, for example, and it's easier to maintain a stable valuation if you can, for example, track rent rolls and bring in data from the external world in order to basically prove the valuation of the token. So that's one area where we see a lot of interest and activity. And then, mentioned funds as well. And so anything in the alternative investment space where you see a lot of illiquidity, so private markets, whether that's private equity or commodities firms, for example. So one of the largest tokenization offerings was a commodities firm out of Malaysia. Things like that, where you have real assets, but the markets are opaque, are difficult to navigate, and traditionally have not given access to retail investors. This is where it might make a lot of sense to explore tokenization.
I'd add that traditionally, when a VC or a family office, private equity, or whoever else invested in the private markets, they would hold onto that investment until the company either went public or went bankrupt, and the very, very limited outcomes or potential for different outcomes. Whereas with tokenization, when you kind of bring the ATS into the mix, which is a secondary marketplace, you create a new kind of liquidity that hasn't existed in private markets up until this point in time. So in general, any company or any firm or any financial markets player who's looking for liquidity to either increase their position or reduce their position or participate in an investment where they didn't know about the primary raise, or you have that, you kind of have that element to it. In general, companies looking to raise money, I think, where there's a B2C business model or a B2B model with a strong network, companies that have very good clarity on, how their solutions or products solve problems and in what communities those problems can be appreciated. I mean, ultimately, an investor is looking for a story. They're looking for something they can connect with, besides obviously the financial outlook for that company. So companies that are cash flow positive or even just generating, revenue, are particularly suited to, kind of showcase their, the tokenization benefits. I was going to add one more point, which is on the companies being or firms being particularly ready for, or industry verticals, I should say. If you look at the fixed income markets and debt finance, supply chain finance, equipment leasing, loans, invoice factoring, that entire trade finance space has long been dominated by large institutional players, right? Banks who raise the funds that get deployed into these facilities. When you tokenize, you create a whole new layer where much lower minimum ticket sizes can start to come into play. And in fact, when studying this global trade finance space, there is a huge deficit that potentially could be plugged through retail or smaller institutional clients coming into play. So I'm absolutely convinced that trade finance, equipment leasing, invoice factoring, supply chain finance is hugely, attractive or attracted to tokenization.
And just a note on, I thought that was a really great point you made, Bob, on the companies that are B2C, and the opportunities that they have in the tokenization space, because this gives them a whole new way to communicate directly with their community. And another thing that you mentioned, Bob, with the distribution, this allows them to distribute not only their, the profits from their investment, but also an easy way to distribute other benefits, like, attaching a utility token that will give them discounts to, using different services. So I know that there is a farm, like a farmer's market kind of tokenization that works that way. You are an investor in the company, but then you also get discounts on the website. The same with, there is a beer company that is tokenized where you are an investor, but then you also get access to the special community and special beers and things like that. And so you're really able to not only give that economic benefit, but make your investors a part of a community in a way that is tech enabled by giving them either utility tokens in the form of fungible tokens or NFTs or what have you. But it opens up this whole new way of connecting with investors.
I'll give you two more examples, only because I think this is relevant for the audience. One of them, you think about sports clubs. For those who pay attention to this stuff, there's a company called Socios that did these tokens that really weren't a true fan ownership model. And the ability for a sports club to raise capital from its fan base, and there's a very special connection between a fan and their club, and being able to elevate that connection to one of some kind of ownership model, or entitlement to TV streaming revenue or merchandise revenue, and at the same time baking in utility so that those token holders get VIP access to to players or to all kinds of different utility benefits. Or you look at more sort of topical things in the investment world, like Web3, AI, metaverse in particular. Every major brand out there is working on its virtual presence, right? Mm-hmm. And just imagine a brand being able to recognize its investor inside a virtual world simply because that investor is connecting their wallet into that metaverse space, and they can read the wallet count and say, right, this guy is an investor in this brand, therefore they get access to exclusive events within the virtual world, within the metaverse, or access to, gaming, avatars and things like that. There are huge, groups of consumers out there that really value, being able to get a skin for or an avatar or a piece of clothing for their virtual, characters. So security tokens and tokenization really open up not just the financial rights that are afforded to the token holders, but also, excuse me, also these utility benefits.
And I'm really excited to see the utility benefits that are beginning to be developed in the real estate space. I think that that's another area where you'll see a lot of great use cases of offering benefits to people who they own a bit of a building, but then that also gives them access to ways to interact with the community that lives there, or you give the folks that live in an apartment complex the ability to own a piece of the profit sharing, and then that can be connected to a utility token that gives them amenities in the community. So there are a lot of different and interesting ways as we're seeing the technologies evolve around token gating, so the ability to allow people into certain either digital or in-person experiences via their token. As those technologies become more and more popular, I think we're going to see that use case explode as well, because those tokens then become more interoperable than a simple, membership points or et cetera, et cetera. That's always the comparison you hear is like, oh, well, if you have an NFT that's a membership NFT, it's kind of like having a membership card, but that misses a lot of the point of interoperability that the blockchain allows for. So I think that the more that we see these projects offering utility benefits alongside the investment value, we're going to see really this idea of interoperable benefits and tradable benefits really explode as well.
Wow. I mean, this last sort of dialogue in the last 5 minutes was filled with so many nuggets. Thank you both. And, I just want to pull out a few that I thought were really exciting. I mean, we started with sort of these high level examples of the sort of the leading the marquee industries where tokenization is taking place. Jeannette, you mentioned real estate. Bob, you mentioned trade finance. But then we sort of said that tokenization and security tokens is an option for all sorts of companies. And you guys gave a slew of really, really interesting examples. And I thought that was interesting. And the second thing I thought was interesting, that it's not just, and Bob and Jeannette, both of you alluded to this, it's not just the financial benefits and the legal benefits. There's also these add-ons. So in real estate, for example, it's not just accessibility and liquidity to this asset class, but there's also automatic streaming of dividends. And then Bob, you mentioned in a lot of these scenarios, one of the downstream benefits could be that you actually understand who the shareholder is, who the investor is, and there's a lot of ways you can build unique things for the community. And so it was really, really exciting. I sort of want to take this conversation to one step further by asking, what are the big financial institutions going to do about this? Because it seems like this is like a very credible and exciting way for companies to raise and companies to get involved. But what are the big FIs doing about it today?
They are actively investigating. They are decisively moving forward with, potentially building private permission blockchains or participating in projects on public blockchains. If we just go through a couple of examples, one of Germany's largest companies, Siemens AG, issued a corporate bond, a couple of months ago. Santander and HSBC put out a report the other day. HSBC have launched their issuance platform called Orion. BlackRock, Larry Fink says very clearly, we are actively investigating tokenized stocks and so on and so on. And the list goes on and on. Citibank came out 2-3 weeks ago, and they actually used language like killer asset class. I'm not making that up. That was the language used there. And it's kind of like, it's a validation that it couldn't be more encouraging and it couldn't be more logical, right? Markets have evolved over time. right? Paper shares to stock exchanges to where the modern stock exchange is empty, right? It isn't what it used to be like with, hundreds of guys in the pits. So it's absolutely logical that, markets will continue to evolve powered by technology. And so, in order not to be left behind, which is, looking at how competitive this space is, everyone really needs to be actively engaged. And I would be extremely surprised, if any of the major banks and even the next kind of, level down of, banking and financial institutions aren't hiring dedicated, blockchain, digital asset, folks to come in and start to chart a digital strategy.
That's absolutely my take as well. You see the hiring actually in these financial institutions. So there was an announcement that BNY Mellon is expanding its digital assets team. Fidelity is doing the same, and Fidelity already has a substantial footprint in the digital asset space, and they're growing their team. And then just to add a couple of more examples to Bob's very already fleshed out list, but JP Morgan has done a tokenized repo pilot out of Singapore. And so they are actively testing how they can use blockchain rails for their intraday trading, for example. And you also have companies like BNP Paribas, which is one of France's largest banks and one of the largest banks in the world, that has done tokenized bond issuances and out of it was out of Europe. I think it might have been out of Luxembourg. And that's really where you start to see a little bit of the differences in approaches based on regulations. So there are fintech sandboxes that exist in different jurisdictions where some of these larger institutions are going and experimenting, and they're actually about to also release a fintech sandbox in Europe. It's a regulatory sandbox where you can launch pilot programs, but they're limiting this to the very largest financial institutions that would like to tokenize equities and debt and things like that. So we are seeing a lot of the different jurisdictions partnering with large institutions to have all of these pilots be developed and deployed, but in a highly regulated way. And so that's what, with financial institutions, obviously everything that they're doing is going to be incredibly buttoned up and incredibly structured and incredibly compliant. But they are doing it, they're experimenting. And I think the theme, and a lot of these large institutions, as Bob mentioned, they've already been doing this. So they've already been launching pilots. They already have blockchains launched. So to mention JP Morgan again, JP Morgan has its own blockchain, private blockchain. So does Goldman Sachs. They have a tokenization platform. And so right now we're shifting from the pilot stage that a lot of financial institutions have already gone into. So I think we're going to start to see that where they go into operation. So it's really that sort of shifting from pilot to implementation and scaling up.
And it's not just them doing it by themselves. I'll give you an example. Recently, we announced the tokenization of a specific company's shares on our ATS. So imagine, shares, traditional shares trading on a public, national exchange in Canada, and a shareholder chooses to list those shares on an ATS in a digital, in a security token format, in a tokenized format. And in the process of us working with that company or the shareholder to tokenize their shares, there was a coordinated effort between that national exchange in Canada, and also a large escrow agent that would basically hold those paper shares, while the equivalent tokenized versions would trade. And it truly is a case of, these are precedents, right? You're basically, forging ahead, and there's a lot of stuff that there is going to be a first. And we've been involved in a few of those, but there's always a collaborative mindset, and it's extremely encouraging, whereby there's true curiosity as to, can we actually make processes more efficient and solve some of the structural problems? And sure, let's give this a go. And this is kind of like the vibe we get. There is genuine embracing of the opportunity that exists. What we just need now is basically that mass kind of adoption, that mass marketing that kind of picks up, and then this just becomes a self-fulfilling prophecy.
Definitely. And yeah, definitely want to bring in that question of efficiency as well. So what does the timeline look like for a company that's looking to issue this kind of security? And then what are the typical ranges that they're raising as well?
I'm happy to go with that. I mean, ultimately, there are some costs associated with, there's obviously costs associated with raising capital. And so, you kind of have to make sure that it's worth your while as a company looking to raise. Typically, you'll look at something like maybe $2-3 million and above as being sort of logical amounts to raise capital. And the amounts can go up into the hundreds of millions, right? It potentially being a fund or real estate projects. So yeah, I wouldn't say there is a specific sweet spot, especially not in this sort of early days that we're in. But yeah, it's, it really is to a large degree dependent on the ability of the issuer to generate the buzz and, market and the investor outreach that comes with everyone raising capital to be able to kind of bring in the investors and the distribution side.
Totally agree with that. And I think that answers the timeline question really well as well, because the amount of time it will take to do this is highly dependent on your existing investor community. If you don't have one, then you need to factor in the time that it will take to build that, as well as, factoring in the time to create a business strategy around this. So a lot of times when organizations are looking at potentially tokenizing, they put a lot of emphasis on the tech, which they should, but they should also take into consideration what is the actual business strategy that is powering this offering. So are you going to be launching this alongside a new product? Is this a real estate deal? Do you have to go out and market this? Are you going to engage broker dealers to go out and solicit investors for you? So there are kind of a lot of questions around just how are you actually positioning your offering from a business and financial perspective to take into consideration. And the more buttoned up someone comes into the conversation with, their buttoned up business plan, they know exactly what they want to do, that's obviously going to be much quicker to formalize in not only in the legal documents, but also on the technology platform. That will be easier to formalize than someone who does not have the business strategy already set up, and they have to kind of work through all of that first and then move on to the next step. So I would say it really depends on the maturity of the organization and how much they're able to develop their offering ahead of time versus how much help do they need with the development of that offering.
Correct. From a technology point of view, you could be looking at days, right? Just to kind of get this stuff set up. It really is that bigger picture that Jeannette alludes to.
Gotcha. And yeah, I think that we saw this sort of in infancy, especially around the NFT craze, and people like Yuga Labs able to raise massive amounts of capital off of their marketing and branding when it came to issuing that. I think that was a great example of the demand and the potential that is there. And so I think that what you two do phenomenally well is have that right mindset around the regulatory angle of it. Because I mean, those types of raises are often used for like rugging and not very good behaviors and lead to a lot of bad actors being in the space, which hurts the reputation. And so I think having that healthy amount of regulation and understanding that process is going to be fundamental for all of the major organizations looking to do this going forward. And so, yeah, those are my two thoughts. I think, Kavi, did you have another question?
Yeah, no, thank you, Patrick. I just wanted to jump in and say one thing, which is, I thought it was really exciting, the institutional use cases you guys were mentioning. It really seems, you mentioned JP Morgan, BlackRock. It really seems like we're coming out of that pilot proof of concept phase into this mass adoption phase. I also, as we're rounding third here, maybe we could go rapid fire if we have enough time. There's audience has really been excited and asking some questions. I'll ask a couple and, feel free to take it however seems best. Someone asked, is the legal structure, whether it be debt, equity, profit sharing, is it encoded on chain in some sort of smart contract, or is it an actual legal contract?
I'm happy to take that one. A bit of both, like definitely in the legal contract, in that PPM, right, in that private placement memorandum, and ultimately in a subscription agreement or token purchase agreement that gets signed once the investment gets made. There's definitely the legal contract that, you know, encompasses the financial rights that the token holder is entitled to. And then technically in the smart contract, some of the logic is embedded into that smart contract. So for example, it could be things like the day and the time and the ratio, the pro rata ratio through which funds will be distributed into a specific wallet. You know, that could also be baked into the smart contract. So it's really a combination of both.
Yeah,
Really
I would agree with that. And just kind of to note the fact that token standards, when it comes to what's embedded in the smart contract, token standards help out a lot with that. There's a token standard called ERC 3643 that does contain certain components of compliance built in. So based on what the legal structure and legal agreements say, you can program certain compliance aspects into the token itself via the smart contract.
Really interesting. Very cool to see us coming out of, you know, the Wild West period we were talking about earlier. Like, that's exciting. Another question, which is, which chains are most of these tokens deployed on?
I want to say Ethereum. I mean, Ethereum generally is by far the most widespread layer one chain when it comes to like applications being built upon it. While INX was going through that 3-year period of convincing the SEC that there was all mechanisms baked into the blockchain to handle various scenarios, one of the scenarios was what happens if, you know, grandma loses her wallet keys, right? And, you know, how, you know, if she owned paper shares, she would just basically figure out a way to contact her broker and get the shares, the paper share reprinted. So at the time, a token format, a different token format from the one Jeannette just mentioned, the ERC 1404 format was released, and it is specifically around security tokens and the ability to kind of manage a whitelist of wallet addresses and to revoke and, you know, tokens and reissue them into a new wallet once you had proven that that person actually owned that wallet. So I think broadly speaking, Ethereum. However, Avalanche is definitely making, you know, big strides in the space. And I know Polygon, for example, the Siemens fund bond that I mentioned, that was actually done on Polygon. So both of which are EVM compatible. So you kind of still have that, you know, Ethereum-esque EVM space, which just renders itself pretty effective in managing these applications.
That's such an important point, and we're wrapping up, but the EVM compatibility piece is key. So as we go into a multi-chain world where tokens are expected to be interoperable, going onto an EVM compatible blockchain is going to be, I think you'll be doing yourself a favor in future-proofing your tokenization offering.
Thank you both so much. I mean, I want to make sure everyone has time to get to their next call, but I just want to say, pass it back to you folks for closing remarks. We've really appreciated the time. Where should the folks in the audience connect with you, and you know, how should your respective companies? Bob, maybe.
Sure. Yeah, so you can connect with Tokenwise at www.tokenwise.co. You can also look me up on LinkedIn. I'm happy to connect with anyone if they have any other questions. And if you want to know how to develop basically a strategy for going into the business of a security token offering and developing that business plan, feel free to reach out. I'm happy to hop on a call.
So we are at www.inx.co. We have offices around the world, so sometimes we're able to actually get people to come in and meet us in person. I'm on LinkedIn, very much having conversations all the time with companies or prospective clients that are looking to raise, kind of co-educating this space alongside with, you know, the likes of Tokenwise and all the other firms that are out there. We are working on a very exciting AI-powered educational resource. So definitely go onto inx.co and sign up to our newsletter, where we kind of, you know, summarize a lot of happenings in the industry and what we do on a monthly basis.
Thank you, Jeanette. Thank you, Bob, and thank you to everyone who joined us today. Really, really appreciate the time, folks.
Thank you
Great
too.
discussion.
Much
Thank you,
appreciated.
everyone.
Bye.
Bye-bye.
Bye-bye.
Awesome. So to send us off, I mean, those are two companies that you just heard from today are two that we're looking at working with very closely over the next few years. And we believe that they are going to play a massive role in bringing Web3 and crypto adoption in the securities and tokenized security space. They're two of the largest or two of the most impressive companies when it comes to how they think about the regulatory side and helping take these companies public. So please reach out to them if you need any assistance in those areas because they know what they're doing. So coming up for Plug and Play, some quick announcements. We have our summit coming up in June. If you're one of our ecosystem members or one of our corporate partners, the dates are up there below. We'll have our FinTech and Crypto Expo on the first day, June 6th. If you're interested in attending or haven't registered, please reach out to Kavi or myself and we'll be happy to get you uploaded. But until next month, it was great seeing you all today. And yeah, enjoy the rest of your time.